Okay. So today we will talk about payout policy. So if you remember this, we went over the financing decision part in the last couple of weeks. So we look at what kind of capital structure decision maximizes the firm value. We talk about the theories behind it, and we talk about what empirical evidence shows. So today we will be talking about payout decision. So we're assuming that the company created some excess cash due to the investments and operations, and we will see whether we should return that cash to investors, and if yes, in what form. So when I say payout policy, first I will talk about different ways firms can pay out to shareholders, and then we're going to look at the information content of those announcements related to payout policy. And then lastly, we will talk about the theories behind payout policy. So first, a couple of information. If firms have lots of excess cash, and if that money is not necessary for future investments, then this money can be returned to investors. And of course, since for mature companies there is more cash, or I should say there's less investment opportunities, it's more likely that mature companies will have more cash to be ready to be distributed to investors. And there are two main ways of paying out cash. One is dividends. The other one is share repurchases. I'm sure you heard of both of them. And we're going to spend a week of lecture on talking about those things. First, let me show you the dividend and stock repurchase pattern in the US from 1980s to 2008. The green ones is the repurchases. When I say repurchase, what I'm talking about? What is it? So companies are repurchasing their stocks from investors. So those stocks will be treasury stocks, exactly. So there will be less shares outstanding for the company, right? These are share repurchases. Last week we talked about issuing stocks, which is just the opposite. Issuing stocks increases financing, money comes to the firm, and there are more stocks available to the public. Okay, and the yellow ones are the dividends. As you can see, in general, payout policy became more favorable. So companies are distributing more cash to investors. But you can also see actually repurchases share in the total payout increase more than dividends. So companies are more conservative about their dividend policies. And this is just another way of representing the same thing. This is the value of share purchases in percentage of total payouts. And as you can see from in 1975, share purchases was around 5% of the total payout ratio. And in 2008, it increased to 70%. So more and more companies are using share purchases instead of distributing dividends to investors. And we're going to talk about why this is the case. Okay, a couple of terminology about dividends. A dividend is a payment of cash to the owner of companies. Who are the owners of companies? Shareholders, exactly. So a dividend payment is made to shareholders. Depending on the number of shares you have, you get more dividends, of course. And dividends are authorized and announced by the board of directors. And in US, dividend payments happen quarterly. In Europe, or in Turkey, it might be annually. Okay, so US market is a little bit different. Also, there are some special dividends. These are one-time dividends, and I will give you some recent examples about it. So on top of the quarterly dividends, companies might have special dividends as well. Some important dates about dividends. One is, this case is for Union Pacific. Suppose that Union Pacific declares regular quarterly dividend of 33 cents per share. And May 6, 2010, this is when the board of directors decided and authorized the dividend payment. This is called declaration date. And once dividends are declared, it becomes liability of the firm. So the company has to make those payments. Then there's ex-dividend date, which is the date shares start to trade ex-dividend. What it means is this is an important date because if you're an owner on the ex-dividend date, then you will have the right to buy the dividend. So if you buy the share before May 16, then you will get the dividend that was announced. If you buy it after May 16, then no chance you're not going to get the dividend payment. So this is the ex-dividend date. And then there's a record date, which is 2 days after the ex-dividend date. So basically, dividends will be paid to shareholders registered on the state. So shareholders of record will be the ones who will get the money. But again, actually, ex-dividend date is important because it is the final date you can get the stock to be able to get the dividend. And the last one is the payment date. Companies literally send checks to investors' houses. So it generally happens 2-3 weeks after the record date. So since you kind of start sleeping, let me ask you the question. If a company decides to start paying dividends, no dividend before, and then they decide to pay dividends, when do you expect to see the stock price reaction, market reaction? When? When it's declared, exactly. So if there is no dividend payment, then there is dividend payment. Another question. So if a company is already paying dividends and there's no change in the dividend policy, which date you think you will see the market price reaction to the dividend payment? Ex-dividend date, exactly, because it's the last day people can enjoy the benefits of dividend. Okay? Okay. Yes. Sorry?
I think I didn't understand the question.
Oh, you answered the first question correctly, but in the second question I said if there was a dividend policy and if the dividend policy doesn't change, then you're not going to see a reaction in the declaration date. But you will still see a reaction or a stock price movement on the last day that you can enjoy that benefit. So you might see the price reaction on the ex-dividend date, if any. Okay?
Why?
But why? That's good. Actually, I have an example about it later in the slides. So we're gonna see it. Okay. Keep you interested. Okay. So let's look at this made-up example, very simple example, to understand dividends better. Suppose that we have this firm. It has $100,000 shares outstanding. It's worth $1 million in total. If the firm issues $1 per share cash dividend, how is shareholder wealth affected? Very easy made-up example. So before dividend, this is what we see. The company has, suppose that the company has $150,000 cash, $850 in the form of other assets. So the total value of the firm is equivalent to total assets, which is $1 million. There are $100,000 shares outstanding. So the price per share will be 1 million over 100,000, which is 10. After the dividend, what's going to happen? So this time, cash will be reduced because this company is paying $100,000 dividends, $1 for each share. So cash will be reduced. Other assets will not change. So the value of the firm will actually decrease to $900,000 with shares outstanding fixed. Price per share will be 9. So actually, when a dividend payment is made, you will see a actually negative effect on the price. And if you remember, it is related to something we used in the corporate finance class. Do you remember dividend discount model?
You mean the growth? If you distribute more dividend, you will grow less than.
Actually, I was going after the basic idea behind dividend discount model. So basically, what you're doing is, what is happening is, you are discounting all the future cash flows of related to stocks, which is dividend payments. So on the ex-dividend, after the ex-dividend date, there will be one less dividend payment you're gonna get. So because of that, you will have a negative price reaction. okay, because you're kind of ignoring $1 payment. So of course, this example assumes there's no market frictions and stuff. I'm going to show you a more realistic example of Microsoft. And actually, in that case, the reduction in the stock price will not be equal to the dividend payment, but it's because we're talking about real world. But I'm going to show you a realistic example after we're done with all the terminology stuff. OK, so what happens with the cash dividends thing is, actually, this is an example Modiglia and Miller will really enjoy, because this basically says dividend payments are irrelevant. There's no change in the value of the firm. Yes, the market value of the firm falls to $900,000, but shareholders will get $100,000 in cash, so the total value doesn't change. But as I said, we're going to talk about different theories, and we're going to look at real-world examples. So we know what dividends are. The second thing is dividend yield. You should remember this from corporate finance class, but of course you don't, so let's go over it one more time. Dividend yield is basically annual dividend payments over the stock price. And this is important. Why this is important? Because when you calculate your expected return on stock, you look at two things. You look at how much return you're going to get from dividend payments, and you're going to look at capital gain appreciation. So if you remember, the expected return on stock, it was something like this. So basically, this part is the dividend yield part. This part is the capital gain, capital appreciation part. So when you buy a stock, you hope that stock price increases, and you might or you might not want some dividend payments, depending on your preferences. OK, dividend yield is used especially to classify income stocks. So what is income stock? Is it the stocks paying more dividends or less dividends? Huh? More dividends, because they generate more income to shareholders. And generally, people who buy income or a group of investors who buy income stocks are big institutions like pension funds or retired individuals or trust funds. Let me ask you, if you are a retired individual, why would you care about dividend payments? Or now, as yourself, what do you prefer? Do you prefer a company paying dividends or not paying dividends? And what's your explanation? Compare yourself to a retired person.
They don't have much time to, not as much as we have.
You shouldn't say that.
And they need a stable income to live.
Exactly. They don't care that much about the growth of the company and long-term prospects of the company. They prefer to buy companies which makes regular payments, like income stocks. But for you, you're young, you don't care that much about your current income, and you care more about the growth of the company. So you might consider a stock which doesn't pay dividends and maybe make investments. But in your case, would you try to stay away from companies which makes dividend payments? This is not there's a true answer, kind of a correct answer of question. What do you think? Would you stay away from companies who pays dividends, or would you rather buy them? If yes, why? If no, why? It depends. I like it. Why?
Based on the smart reaction, smart also what you expect when they are paying dividends.
What do you mean? What do you expect?
After they pay dividends, their stock price will fall. If you expect
Okay. What else?
I think it is related with the future projects and their outcomes. So
Mm-hmm.
if the company has planned to develop a very profitable project, I will not care if it pays a dividend. So it will return as a capital appreciation. So
Mm-hmm. I agree with him. Are you going to say the same
I
thing?
think it depends on company, because some companies have not chance to grow
for example, like Array, they will check, it's very huge investment, they need very huge investment to grow. So they, if I can prefer this, if they give dividends, because their profit will be dividends for me. So I can invest this, but if it's a small company,
We will talk about the life cycles of companies and their dividend payment strategies, but I'm not going to show you anything shocking. It's going to be all common sense graphs, of course. But there are different ways of looking at things. One, you can say, okay, yeah, I'm young. I don't need the dividend payment now. So who cares? You can say that. But you can also say, okay, I will get the dividend payment and make more investments in the stock market. So it doesn't hurt you to get dividends. So this is the investor side, like getting the money or not. Or you can look at the company side, and we're going to talk about this. You can say, okay, this company has lots of cash. That's why it's distributing dividends. It might be a good thing, or it might be a bad thing. Why do you think having lots of cash might be a bad thing for a company? Yes, it might mean there's less investment opportunities, so they cannot invest. Or think about agency conflicts. Or
So management uses 4 days.
the manager doesn't want it doesn't try to he doesn't want to try, or he doesn't spend time trying to find good investments. So it might be a preference thing, or it might be a mature industry thing. Okay, so it might be agency conflicts or the market structure, let's say. So having dividends or not might be a good thing or bad thing. It all depends. Yes.
The minimum rate of yield.
No, I will. Is it here? I'm going to show you things now. We're going to look at more graphs. Yes.
is there any obligation about dividends?
No. What do you mean obligation?
Legal obligations.
Like, do you need to give dividends or
Some
not?
companies,
Most companies don't pay dividends. In US, 2/3 of companies don't pay dividends.
some companies pay annual dividends.
Yes, it's also fine. In US, it's generally quarterly, but it all depends which country you're looking at. But as far as I know, there is almost no legal obligation. No government can force a company to pay dividends or not. Okay, let's look at a couple of graphs, some more realistic things that I think you will like. This is from Robert Shiller's data. Do you know Robert Shiller? He won some award, not that important. He just got Nobel Prize, you know? Okay, one of the 3 finance professors who won the Nobel Prize last year. Okay, so this graph shows you what happens to dividend yields from 1890s to 2010. This green line is the median dividend yield. And as you can see, it is really volatile. But in recent years, we see a decrease in dividend yield, for instance. So this part is very interesting. So this is the 1929 Great Depression time. And dividend yield was so high, like 12%, pretty high. So why do you think in Great Depression dividend yields were so high?
Because of inflation, they distribute the money at value.
Something actually very simple.
Because the stock price is low.
Yes. So what is dividend yield? It is annual dividend payment over stock price. So if the stock price is very low, then dividend yield will look very high. Good catch. Okay. So don't focus on whenever, okay, you will work in companies and you will deal with ratios and stuff. Every time somebody shows you a ratio, you have to think about both the numerator and the denominator. So in that case, even if dividends are fixed, because of the decreased stock price, you're going to see an increase in dividend yield, which might look surprising, but it's actually not. Okay, so that's one thing. Another thing is from a blog. So what this guy did, he actually looked at around 6,000 firms, and according to their dividend yields, it classified those companies. As I just said to Batu, 2/3 of the companies pays no dividend. This is a figure from 2012, okay, for US companies. 2/3 of the companies paid no dividends. And if you pay attention, you see that dividend yield is around 2% for the median dividend yield among all those companies. There are companies whose dividend yield is less than 0.5%. There are companies whose dividend yield is higher than 6%. But it might be because of two things, high dividend payments or low stock price. But this doesn't give any information on it. But in general, we say dividend yield is 2% for US companies. Now let me give you more terminology, stuff you already know. Payout ratio there's dividend payout ratio, which is basically the dividend as a portion of earnings. So it is, oops, where is it? Okay, yes. So this is dividends over earnings. Earnings come from which statement? Income statement. If you remember, once you construct income statement, you end up with net income. Part of the net income is paid to shareholders as dividends. Part of it is kept in the company as retained earnings. Okay? So this is dividends over earnings. Total payout ratio is how much money is returned to shareholders in form of dividends or in form of repurchases compared to earnings. And whatever is not paid out is called, it's plowback in the company. So we have the plowback ratio, which is 1 minus the total payout ratio. This is also called retention ratio. So I'm sure you remember those from the corporate finance class. Okay. What kind of companies do you think have high retention ratio? So they keep more money in the company.
R&D company, look for R&D, like medicine.
Okay. Is it because they have lots of cash or?
No, it's because they need a lot of reinvestment.
So basically he says high growth, high R&D intensity companies should have higher plowback ratio. They shouldn't pay out cash to investors. What else?
Companies, baby companies, like needs to grow more.
Startup companies.
Kind of.
Exactly. So yeah, exactly. This is what I was going for. You might have like 10 different answers to this question. But yes, mature companies will have more plowback ratio. Growth companies will have less. Just opposite. Growth companies will have more plowback ratio. Mature companies might be just the opposite. Okay, and let's look at the equivalent graph for dividend payout ratios. This is again from the same website, stingyinvestor.com. And this is how dividend payout ratio moved in the last 100 years, 120, 30 years. As you can see, the median payout ratio is around 60%, and it's changed a lot during the years. But recently, now it is around here. Okay, so we are 2012, 2013. Another way of looking at the same thing is, and I'm going to ask you a couple of things from this graph. So this is for US companies for 2009. And again, this Professor Adamodar from NYU. By the way, I put this link here. This chapter is all about payout ratios, and I'm using lots of graphs from that book chapter. So if you are interested, you can print that. It's 40 pages or so. I think it's not very long. Okay, so what he did is he looked at dividend payouts. This is the dividend payout ratio for US companies in 2009. And we look at the number of companies with different payout ratios. As you can see, most companies' payout ratio is around 30%. Here, we have the highest thing. Some companies have negative earnings, but positive dividends. So even if they have negative earnings, they still continue to pay dividend payments. Because if they didn't, probably there would be a very big and bad market reaction. But how come a company pay dividends more than 100% of the earnings?
Does it include the repurchase?
Nope, this is just for dividends. This is also called liquidating dividends, actually. Okay, probably it was too much to expect an answer from you from this. But basically, when companies are in trouble, they sell their assets. So when they're in bankruptcy. So this is liquidating dividends is a special way of returning money to shareholders. So after they pay off the debt holders, they can return money to shareholders in that way. So they're really liquidating the company. So it's the case when you see more than 100% dividend payout ratio.
Is there any real case like this?
Yes, I'm sure there are like more 100 firms. This is real data. So, okay, but I didn't look for it. But you know, I will look for it for next.
Negative indicator of the welfare of company.
Ooh, this is the bankrupt case. It's they're dying.
Like looks like quite a lot companies are in this situation.
Yeah, but look at the year 2009, just after the crisis. So it's not that surprising to see many companies there, right? Okay. So recent dividend trends in the US. So basically, as I said before, dividend payments have increased a lot over time in general, but the proportions of stocks paying dividend decreased. So in 1970s, 70% of companies were paying dividends. Now it's around 45%. Average dividend yield, as you saw in the previous graphs, is around 40% now. It decreased. And share repurchases become more popular. And we're going to go into the reasons why it happened. When you compare dividends with earnings, you expect to see a positive or negative relationship. More earnings should mean more dividends. And this is exactly what we see. The blue line is for dividends. The green one is for earnings. And as you can see, as earnings grow, we see dividend payments grow as well. Another thing to pay attention to is this one. Dividend series is much smoother. So you see more volatility in the earnings trend, but for dividends, you don't see it. Another thing to look is after the crisis, so if you see it, the blue line is actually higher than the green line. So there's more dividend payments compared to earnings. This is exactly what we saw in the previous graph here, liquidating dividends case. So we see companies getting in trouble in terms of earnings in late 2000s. Okay. Another thing is dividend policies around the world. So I don't know whether you can see it, but we have US, Japan, Germany, France, Italy, United Kingdom, Canada, and Russia. And those 3 bars is for different time periods. So we have 82, 84 case, we have 89, 91, and we have 2008, 2009. So as you can see, companies show some changes in terms of their dividend payout ratios. So for instance, in Japan, as you can see, the payout ratio was very low in 1980s compared to any other companies, but then it increased a lot. Why do you think it was the case? The dividend payout ratio was really low for Japan compared to other companies. Why do you think? What other countries, I'm sorry.
Maybe because of foreign investments in Japan?
It's something simpler, actually, something we talked about before. Think about Japanese economy in 1980s.
No growth.
No growth?
80s.
80s. Yes, exactly. Japanese companies were growing like crazy in 1980s, so they weren't paying dividends. They were using the money for growth. But then, as you can see in the recent trends, more recent trend, they have big dividend payout ratios because now they're more mature. They don't have much investment opportunities left. Look at Russia, by the way. It's like a hot topic now. Russia was not paying anything before. Now we see some payout thing. The reason why I'm pointing this out is, of course, dividend payout ratios will change according to the law systems of companies and the governance systems of companies. That's why we see this interesting trend with Russia. Another thing was, what was I going to say? Yeah, I don't remember. There was one more thing, but I forgot. Okay, so this is how dividend policies change around the world. So when you're comparing countries to countries, you should think about their governance system. When I say governance, I'm also talking about corporate governance system. You need to think about their tax system. Oh yeah, I think this is what it was about. So in some companies, the taxing of dividends is different. So if a country has more favorable taxing, then companies might prefer dividend payments instead of share purchases. So because of that reason, you might see a difference in different countries. And I'm going to talk more about tax in the last hour. Okay, so tax is important. Growth stage of companies is important. Governance system is very important. Legal governance systems are important. How do companies decide on dividend amounts? They can set a dividend payout ratio, and they change dividends according to their ratio, or they set a target dividend growth rate. And it's actually what most companies generally do. The companies don't care about dividend levels that much, but they care about dividend changes. Because whenever there's a change, we're going to see a reaction. And I'm going to show you more stuff on it. And another thing about dividends is related to what we saw, related to something we saw earlier. This really messy graph actually shows you how earnings change, how price change, and how dividend changes. So as you can see, earning changes, I think the blue line is the earnings. As we saw before, earnings changes are very, very volatile. Dividends are smoother. That's why we call them sticky dividends. So you don't see lots of changes in dividend payments. They're sticky, okay? And compared to price, earnings were also very small. There are lots of theories about earnings and dividend ratios and things, but I'm not going to go into that. There are lots of debates on it in academia, but again, I'm not going to go into that. But what you should keep in mind is companies do not change their dividends. They pay attention to changes in dividend a lot, not the dividend levels. And dividends are sticky. So this graph will just confirm what I just said. So from 1988 to 2008, you see a 20-year period of companies deciding on three things. No change in dividends, dividend cuts, or dividend increases. As you can see, most companies, the green one is the no change in dividend. Most companies are not changing their dividends because it's going to look bad. And the blue one is for the dividend increases, and the red ones are for the dividend cuts. So if a change is going to be made, of course, companies do it to increase dividends, not to decrease dividends. Because, of course, dividend cuts will give a very negative reaction. Will take a very negative reaction from public. Another graph of showing you how dividends don't change much is from GM's case. You see how volatile earnings of GM was. It was really in trouble. But changes in dividends were less likely, or dividends were smoother and they were sticky. So the takeaway from all those graphs is earnings are more volatile than dividends. Dividends are smoother and dividends are sticky. And companies don't like changing dividend levels. They focus on changes in dividends. I asked you what kind of firms tend to pay dividends, and you gave me the correct answers. But let's just tabulate this, the same thing. So we talk about how firms can have different stages in their life cycle. So we might have new firms. This is the introduction case, startup companies. We might have expansion, growth, and decline. Okay? So in the introduction part, we talk about the financing needs of the companies. Of course, in the introduction, companies will need lots of funding. They're not going to have lots of cash flows. Actually, they will have huge expenses and not much sales. So cash flows will be negative. And dividend policy, we don't expect those companies paying dividends. In the expansion case, they still need lots of money, but they start getting some cash flows. And they might start distributing dividends, depending on the company policy. In the mature growth case, there is moderate funding, cash flows are increasing, dividend payments are increasing. And the last part, the decline case, there will be less or no funding needs for those companies. They will have lots of cash flows, and they will have, on top of the normal dividends, they will do special dividends and repurchases. This is another graph of looking at the same thing from Professor Adamodar's book. This is the earnings per share growth of companies, and these are the dividend yields. As you can see, high growth companies will have less dividend payment. They will have less dividend yields, as expected. High growth companies, they pay more dividends. Okay, the same thing, what we just said. Okay, let's look at this case. I think this is really interesting, and I think you will like it. This is from Microsoft. Okay, in 2004, Microsoft had the record of holding the most cash forever for a corporation. It has $40 billion in cash. Okay, and there was $1 billion cash flow every month on top of the cash flow available. So in 2004, what can you do with this $40 billion? You could have bought eBay, Yahoo, Amazon, and then has $10 million to spare, the chewing gum money, okay? Or you can buy the entire airline industry twice. I'm talking about crazy amount of money. You could have bought 23 space shuttles, this was pointed out by a friend of mine, a male friend of mine in US. He said they could have bought every baseball, football, basketball, and hockey team in the US. So crazy amount of money. What did Microsoft do? Of course, they decided to do a special dividend. So on July 20th, they announced a $3 per share special dividend. And date of record was November 17. The payment date was December 2. There was 10 billion outstanding shares that time. So they were planning to pay out $32 billion in cash to investors. Almost like all of it was going to be paid out to investors. So what happened to let's look at the market reaction. Stock closed at 28.32 on July 20 when they made the announcement. And they made the announcement after the trading hours. On July 21st, of course, there was a favorable stock reaction. There was a 5% increase in the stock price. And then let's look at the other things. The date of record was November 17, which means ex-dividend date was November 15. What happened that day? Of course, you are going to see a huge price reaction that day. So anybody who bought the stock that day or after that, they weren't going to be able to get the special dividend. So what happened is on that day, the stock price decreased by $2.6. So this was a $3 special dividend case. And you see on the ex-dividend date, you see a price reduction of $2.63. So normally, remember in my previous example, I said this is a very simple example, and you should see a decrease in stock price equivalent to the dividend payment. But of course, in the markets, we have lots of frictions, and you don't see that $3 relating $3 decrease in the stock price. It was less than 3. But you would definitely see a decrease in stock price on the date that will affect whether you will be able to get the special dividend or not. Okay, so that was, you see a favorable market reaction on the announcement date for the special dividend, and then you see a negative price reaction on the ex-dividend date, because it was the date you're losing your privileges to get the special dividend. So what is Microsoft doing now? I just looked at the data last week. So now they have cash reserves of about 83 billion. So they pay quarterly dividend of 28 cents every quarter. And they do lots of stock repurchases. Like they did a 40 billion stock repurchase last year, for instance. So they are distributing money. And the dividend policy they announced is this. Let's just read it. The board will continue to evaluate whether to pay a dividend on a quarterly basis and will base its decisions on the company's potential future long-term capital requirements relating to research and development, investments and acquisitions, dilution management, and legal and business risk faced by the company. So basically, if a company has lots of cash, we would expect those companies returning that money to investors in a way, in dividend payments or share purchases. But as I said before, share purchases are more common in recent years. Let's look at valuation of stock prices, and let's solve a simple question on it. This is a reminder. You did this in corporate finance class before. If you remember, we do Gordon growth model to calculate the stock price. So basically, the stock price is, in general, is the discounted value of all the future cash flows. This is not just valid for stock. This is also valid for any kind of assets you can think of. How to value an asset, discount, or calculate the value of all the future cash flows. For stocks, there are dividend payments. And we assume that dividend payments go on forever. So in that case, this turns the stock price valuation into a what? If you have infinite number of payments. Thank you, perpetuity. And here I put the general form where you have some growth. So you get your dividend payment from company records, and R is the required rate of return on the equity, and G is for the dividend growth or sustainable growth rate. So from here, you can calculate the value of a stock. Let's look at this example. What is the value of a stock that expects to pay a $3 dividend next year and then increase the dividend at a rate of 8% per year indefinitely, assume a 12% expected return? How do you calculate the price of the stock? It is you are just using the formula. It's very simple. So you do D1, dividend payment of next period, over R minus G. Everything is given. Dividend payment is $3. Price is return on equity is 12%. Growth rate is 8%. So 75 is the price of the stock. Is this the market price? I calculated some price, and I'm telling you this is the price of the stock.
Terminal value. Terminal value.
Or I say fair value. Yeah, this is the fair value. This is your forecast of the fair value of company. So to you, if this is a dividend payment, if this is the growth rate, and if this is the required rate of return on your investment, the price of the stock should be 75. So it can be higher than 75. It might be lower than 75. If it is $80, for instance, would you buy the stock? The market price is $80. Huh? The market price is 80. Would you buy the stock or not? You shouldn't, because at that time it will be an overvalued stock. Fair value you calculated is $75. If you buy the stock at 80, so your rate of return will be less or more than 12%. You buy the stock at 80. What's going to happen? What's going to happen to your return? It's going to be less than 12%, right? If you buy the stock at the fair price, your return will be 12%. If you buy an overpriced stock, your return will be less than 12%. Okay, this was just side information. Okay, very good. Now I'm changing the question a little bit. So the question becomes, what is the value of the stock which just paid a dividend of $3? The expected growth rate is 8% per year. Assume a 12% expected return. Everything is same. The only thing I'm changing is I say this stock just paid a dividend of $3. So would you consider that $3 in your stock price valuation? No, right? You're thinking about buying the stock. The dividend payment is just made. You missed it. Is it going to affect the valuation of the stock? No, it's gone. You're not taking it. So I'm always interested in next period's dividend payments because it's the dividend payment I'm going to get. So what are you going to do? You're going to calculate next year's dividend first. So if dividend payment just made was $3, you're going to grow that dividend payment by the growth rate. So next year's dividend payment will be $3.24. Then we're going to use the same formula. 324 over 12% minus 8%. The price is $81. So this is just, be careful if in case in the exam I ask you a question like that. Just look at the future cash flows all the time. That's really important. Okay. Let's take a break here. 5-minute break. 5 minutes even.